Okay, so now I want to take you up to the next big episode in mortgage finance history, which is the savings and loan crisis. There's an interesting book called Building Home. It's a billed kind of as a biography of Howard Amundsen, the founder of home savings, big savings and loan in California, but it really does a nice job of capturing kind of the atmosphere of sort of post World War II housing markets and savings and loans. So what you have, as you recall, we now have deposit insurance. We have the 30-year fixed rate mortgage. Which is amortizing. We have deposit interest ceilings. And finally, we have what I would say is a cozy relationship between government and S&Ls. And I guess another point I should make is that the S&Ls, savings and loans, can only operate in one state typically. So there's not much. We're not talking about national institutions. We're talking about institutions that operate at the state level. Some of them get to be very big, particularly out in California, but we're not talking about national banks, national lending like what we see today. So anyway, we have this cozy relationship between government and savings and loans. That is, policymakers really wanted to have a lot of middle-class housing built in the post-war period. They wanted to increase home ownership, and so when financial regulations were being tweaked in the 1950s and 1960s, the tweaks tended to help the savings and loans get money, because the savings and loans would in turn lend money to middle-class home buyers. So they got the ability to pay slightly higher interest on savings deposits than banks could, things like that. Little regulatory tweaks that kind of help the savings and loans grow. And again, that book describes some of that, what that atmosphere was like and how that process worked. But by the late 1960s, there were problems starting to appear, because inflation starts. So in the late 60s, inflation starts to go up, and that puts pressure on interest rates for two reasons. One is depositors or would-be depositors start looking for higher returns elsewhere, and second, the Fed is starting to think about raising interest rates to reduce inflation. So rates start to go up, and we start to see a phenomenon called disintermediation. That is, what that means is that savers look outside S&Ls for opportunities to earn higher returns. Okay, because the savings and loans are still mostly tied to regulation of their deposit rates. There's also the savings and loans are kind of putting pressure on one another not to raise rates, because they're locked into 30-year mortgage assets, and if they have to pay more for their cost of funds, eventually they'll start losing money. So we start to see the phenomenon of disintermediation. In the 1970s, Merrill Lynch invents the money market fund, which really accelerates disintermediation. I think they do that around 73, 74, something like that. So you see money market funds, and they start to pull money out of savings and loans. So that and then of course the 1970s inflation really shoots up. We eventually get double-digit inflation to 10% plus for a few months near the end of the 70s. And that high inflation basically kills the savings and loan industry. Between disintermediation and then the gradual raising of deposit interest ceilings. So deposit rates are sort of not high enough to prevent disintermediation, and not low enough. Well, there's just basically nothing they could do, but they're not low enough to keep the S&Ls solvent. I mean, the only way the S&Ls could be solvent, having issued, let's say you've issued a 30-year mortgage at 6%, and now short-term rates are 8% or higher, well, there's no way you can be solvent in that situation. And so what happens is that S&Ls, because they're losing money, because deposits are leaving the S&Ls turn to the capital markets to get money. And there they have to pay very high rates, and of course that means that the cost of their funds exceeds the earnings that they're getting on these old mortgages. So as the 70s proceed, we also see the introduction of new securitization, basically by the government. The government does a couple things. One is it creates Ginnie Mae. I think it creates it in about 1968. 1969 is maybe when the first securities get issued. And these are FHA insured mortgages, and they're packaged into securities. And part of the reason is the S&Ls can no longer supply the funds for these, so they're trying to mobilize capital from the capital markets to get into the mortgage market. That's part of the idea. A cynic could say that this is sort of Wall Street trying to get involved in the mortgage market. So we go from the capital markets to mortgages via Ginnie Mae. And then another thing is that Fannie Mae is privatized, and probably the main motivation for that is to deal with problems with the debt ceiling. That is, President Johnson, every time he goes to Congress to raise the debt ceiling, gets attacked, and it gets tied in with the Vietnam War and with his war on poverty, and so there's a lot of political problems with the debt ceiling. So if he privatizes Fannie Mae and gets the mortgage debt that Fannie Mae has off the government books, then he doesn't have to go back and raise the debt ceiling. So Fannie Mae is privatized. That sort of frees Fannie Mae to broaden its involvement in mortgage markets. And then finally also we get the creation of Freddie Mac. And the purpose of Freddie Mac at that point is to deal primarily with the shortage of mortgage money in California. you have the California savings and loans. There's not enough savings in California to fund all the housing demand out there. And so what Freddie Mac does is because banks cannot and savings and loans can't really operate across state lines, but Freddie Mac can. And Freddie Mac is like Ginnie Mae in the securities business. So Freddie Mac, just to back up, Fannie Mae is holding loans in its portfolio. It's like a gigantic savings and loan. So holding loans backed by its own debt, or funded by its own debt. So holding loans funded by its own debt. Freddie Mac is not holding loans, it's issuing pass-through securities. And so if someone in New York buys a Freddie Mac security that has a lot of loans from California, that's a way of getting money from New York to California that the savings and loans couldn't do. So Freddie Mac solves that problem, and it also just generally gives savings and loans access to capital markets. When Freddie Mac was started, Freddie Mac was not a private firm. It was a part of the Federal Home Loan Bank System, which was one of the things that was set up to help the savings and loans. So Freddie Mac is under the Federal Home Loan Bank System, and its job is to enable savings and loans to get access to capital markets, so that because their deposits are drying up because of disintermediation. So they're not getting deposits because the interest rate ceilings on deposits and things like money market funds are encouraging savers to put their deposits elsewhere. And so what we're trying to do is get capital markets to mortgages, and that's a big reason why Freddie Mac is started. Now what that's going to do, of course, is raise the cost of funds to savings and loans, because when they go to the capital markets, they're not going to have these ceilings on their rates. They're just going to have to, but they can sell mortgages in order to get more funds to lend. So instead of having to hold the mortgages themselves, they can sell them, and other investors can buy them, and that's kind of what Freddie Mac is set up to do. Okay, so we have all those things, but what happens is basically the S&Ls are underwater. They're lending. They've still got a lot of outstanding lending at 6%, left over from the late 60s, and they're borrowing at 10% or more from capital markets, and that's obviously not a good business. And then in the 1980s, these S&Ls are deregulated. That is, they're allowed to invest in commercial real estate, for example, office buildings, other things. And the net result of that is they make a bunch of really bad investments. Remember, they're underwater to begin with, so in some sense they have nothing to lose. The deposits are insured by the FSLIC, that's the insurer for S&Ls, and so they make a bunch of bad investments, and so they go from bad to worse. To make a long story short, they go from bad to worse. And by the end of the 1980s, pretty much the entire industry, most of the industry is bankrupt. Or certainly a lot of the big firms are bankrupt. So what are the policies? So and again, there's a bailout formed. The regulators create a fund to buy up. So if a fund buys the assets of the failed S&Ls and then ultimately disposes of them at a loss to the taxpayers of about 150 billion, which at the time seemed like a ton of money. Nowadays maybe it doesn't seem like so much, but at the time it seemed ridiculous and it was traumatic. And so what were the lessons that policymakers learned from that? One was that they thought that deposit finance was unstable. So regulators developed a preference for using securities. The thinking being that somehow that deposits are short-term, security investors will be more long-term oriented, and so this will produce a better match between long-term funding sources and mortgages, which are long-term. Okay, so that was the first lesson that they thought they learned. Deposit finance is unstable, so let's prefer securities. Another lesson that they thought they learned was that mark-to-market accounting was essential. And the reason for that is that one of the things that made the savings and loan crisis drawn out for a long period of time was that savings and loans could carry mortgages that, had they been tried to sell them in the market, might have been worth $50,000. They could carry them at their historical value of $100,000. And so the savings and loans were able to stay in business much too long and then take large gambles. Now you have to be a little bit careful here in blaming. So the opposite of mark-to-market is historical cost. So versus historical cost accounting. Or book value, or sometimes called book value accounting, where you say, if I put this on the books at $100,000 in 1968, then by golly, it's still $100,000 today, even though its current market value is $50,000. That's what I mean by historical cost accounting, and that so that was unrealistic. But you have to remember that at the time, this whole time you've got Congress. They're still friendly with the savings and loans. It's still the 1950s and 1960s to them. And so a lot of the pressure not to recognize that the savings and loans were bankrupt and not to put them out of the business really came from Congress. And a lot of the deregulation, which was poorly timed, letting the savings and loans try speculating in different assets at a time when they're actually underwater. Again, a lot of pressure from Congress for that. So in any case, the regulators decided that the accounting, that we need to have more mark-to-market accounting in order to address that. And then another lesson was the need to connect risk to insurance premiums, that is, deposit insurance, and and to have risk affect capital requirements. Regulators were pretty convinced that if they didn't assign higher capital requirements to banks and savings and loans that required riskier assets, that the regulators were setting up the insurance fund to be gamed. They were pretty much traumatized by the way that savings and loans invested in very risky, commercial real estate, and that this really raised the cost of the bailout. They would have liked to have been able to assign higher capital requirements to savings and loans that took riskier strategies. So again, the three things that came out of this were a preference for securitization, mark-to-market accounting, and risk-based capital requirements. And what we'll see next time is that these were the factors, the exact factors that caused the blow-up in the 2008 crisis.